Hey you guys, Freaky Finance here. It's another crazy week. Today we're going to do another fun video, this time on bonds. We're going to go into an investing 101 thing. We've done one of these before, or two of them now. And the reason why is because a lot of people hate on bonds for the last 5 years, which is fine. But there's a purpose to them, and we're going to kind of go through it why. And we're going to make it relevant to current times and what's currently happened, right? So we know from the last few videos that fear was very high, really since February. Even before the tariffs were announced, which shot the market down even farther, the market was correcting. It was in a state of panic for about eight weeks in a row, right? And so the last three videos have been kind of basically, we weren't sure it was at bottom or not, and all we were doing was buying. And so this video is going to be about bonds, but it's kind of like, where does the ability to buy things come from? And that's why bonds are important, because it unlocks the ability to buy things and have a steady headspace when things are going down. So you have a plan. There's a whole bunch of different things in terms of risk tolerance and ability to take risks that we're not going to get into because the video would be too long. We might do that at some point. We've kind of talked about portfolio structure before. But anyway, like, where did all these gains come from? Most of these are new positions, except for, say, Shopify and on this page anyway, right? Like, we've owned Google before, but I got to average in. I owned Amazon before, I got to average in, right? I owned AMD. I never owned AMD before. I got that. I'm already up 26% in it, right? Right. I bought the index up 12%, right? And this is just in the month, less than a month since we bought them. So that's the power of having ammo. And we're going to go into these concepts really quick. It's the ability to take advantage of fear. And that's what I believe, at least in my opinion, from my point of view, bonds unlock the ability to take advantage of other people's fear. Or at least in my headspace, it does. It gives me the ammo that I need to buy things, right? You're not going to get everything right. Like, I was buying global payments at $90, and this thing decided to buy a random company, overpay for it, made itself more riskier, and the thing shot down to like $60. So I had to buy a bunch to average down. But even then, you can see over time, just picking up great companies when there's fear in the market does add value, right? That's just a SPY up 13%, which I'm already trimming. Starting up to get the cash again for the next panic, right? Or putting it into safer things because you have so many equity exposures already, right? Or start experimenting with a regional bank that's probably going to benefit from deregulation down the road, right? We dropped that name before, right? Or random trades for Tesla. Like, this is just a trade. I'm not going to hold it, right? But you can see this, the little extra 25% just like that, right? That's how you can take advantage of fear. And these are all real trades. So technically, I still own them. So I'm just trying to convey, like, where does this come from? And it's linked to bonds. And so I want that to start this off because, one, we've talked about equities almost all the time, but they're linked together in terms of risk management and your ability to take advantage of fear. So with that, we're going to jump into bonds. Some of you guys might already know a little bit about bonds. Some people know nothing about bonds. And I've owned bonds for 17 years. On and off, and basically I use them as defense to take advantage. So we've seen this chart. I actually shared this chart before in another presentation. Is basically bonds are kind of in between cash and stocks, so they play defense more than offense. And you can see in terms of inflation, where cash and savings generally doesn't perform as well, like it doesn't cover inflation, the cost of living increasing. Bonds actually do, but barely. And then you can see stocks in the long run outperform. And that's kind of what you expect because stocks are riskier than bonds. So why would I buy a stock if it wasn't going to give me more money than a bond would, right? In terms of volatility on the right side here, we've talked about this before, and you can see emerging market stocks and international stocks and small caps have actually been more volatile, which is how people measure risk. So the range of outcomes is very high. So you can either make a lot of money or lose a lot of money. And that's how they measure risk. They do standard deviations and stuff like that, but we don't need to get into that and all the assumptions behind it, but that just helps frame things. And you can see REITs and large caps, still a lot of volatility. Gold, actually a decent amount of volatility. And then you can see bonds. As soon as we go into international bonds and all US bonds and out of high yield, you can see the range of outcomes gets a lot smaller. So that smaller is more defensive. Now, this is kind of how my brain works. This is not, you never won't find this in a textbook or anything. This is just how I treat things. So defense is my fixed income, my GIC is my cash, and my gold. That's just how I treat it. And then if I'm trying to play midfield or I find something interesting, I'll try to go into REITs and preferred shares, and that's usually what I try to do later on in the cycle, is play more defense and midfield. And then partially because I'm younger, partially because my ability to take a lot of risk. Generally, I'm usually overweight equities, and that's why the channel is also on a lot of equities, because I'm in them, so I need to follow them. So a lot of this channel, I mean, is for me, right? It's just that's just how I view the things. Now, commodities is arbitrary. You could say, well, it's kind of defense because it can be correlated or uncorrelated. I treat it as offense because, yeah, it can be uncorrelated, but it also swings pretty hard if you're right or wrong. So I view it, because of the risk profile of it, I view it as attack. So kind of offense. So that's just how you treat the thing. So bonds are kind of like your defense. They're not gonna shoot the lights out unless you're taking a lot of risk in them, which we'll talk about. There's risk drivers in them, and all these things aren't the same. So what's a good chart to show? The next slide, I think. Yeah, this one. Not all equities are created equal. Not all bonds are created equal. So putting them in those little baskets, this soccer field chart, is kind of an injustice, because there's certain degrees of risk within each asset class, which is what these are, asset classes. So here you can kind of see just in the blue, even just emerging market, small caps, higher risk than blue chip, large cap equity. So basically higher quality companies that have been around a long time, probably stable, like your Pepsi equity is a lot less risky than my Tesla equity, right? That's here within, but it's still in an equity range, even though the risk profile isn't as extreme in terms of volatility. REITs, like I said, are kind of in the middle. And then you have high yield, investment grade, and government bonds, which is what we're going to focus on today. And we're going to talk about duration and interest rate risk and inflation, because these things are topical. And it is important to know. So what it really is a bond, I guess, to start with. A bond is really a loan made by an investor to a borrower. So someone gives you money for something. And borrowers are usually corporations, municipalities, or governments. Doesn't have to be, but usually is. And bonds are used to fund projects or operations usually. Sometimes people will actually issue debt to buy back shares, but most of the time, for 9 out of 10 cases, most of the time they're borrowing money for a reason, to start a project, to invest in something. So really it's a source of financing. And in this case, instead of saying, I know this word choice uses investor, you're really like a lender. You're lending to them, and you actually have a claim on assets usually. And we're not going to talk about covenants and things like you have strings on the company because you lend to them. To think of yourself like a bank. You're almost like lending to somebody, and now you have a claim on some assets. That's kind of how bonds work. It's different than equities, where you just have a stake in the ownership, and if it goes up or down, it can go to zero and you get nothing back. Bonds will usually have a recovery component. Though again, that can depend on the company and how much leverage there is, and where you are in the credit structure, which we're not going to get into today. But this is kind of just shows the overall context of people basically borrow money and they put it to work to build things like a nuclear power plant, so infrastructure, because utilities are a huge issuer of debt, which we've talked about on the channel before. So why would this transaction happen? Basically, in return for giving money, the borrower pays interest, and it can be fixed or variable, and we're not going to get into that either. We're going to just assume they're fixed income. So they would just pay a steady amount each time. So you can see here, if you just give money to a company and you guys agree that for $1,000, they're going to pay you 10% back over 10 years and then pay your money back at the end of 10 years. This is what it would look like. You basically give out $1,000 off the start, and you get $100 back every single year for 10 years, and then you get your money back, hopefully. And that's how bonds work. And now there's going to be certain things in your head. You should be like, okay, what could go wrong here? And there's a couple things. One, the duration. So the length of time is a source of risk. So the more you lend money out farther, the more you expect to make. So your rate, so in this case, the 10%, say if I was only lending for 5 years, I might only get 7% or 5%, right? Depends on the company. But that it's basically the longer you're willing to lend people money for, the more you should expect to get. One, because it's more riskier the farther you're lending out. But two, you have time value of money components. So $1,000 that you're going to get back in 10 years is not going to be worth $1,000 you gave them in year 1, right? Or year 0. So those are concepts to keep in your mind. And then also, the longer you lend out, anything could happen to this company, right? Maybe they're credit worthy today, but 10 years from now, they might not be so credit worthy, right? So what things would you want to know before you lend $1,000 to an individual or government, right? Or company? And most people would get the first one, right? So credit risk. So you want to make sure they can pay you the money back. So if you give somebody $1,000, you want to make sure they can actually give you the $1,000 back. But a lot of people don't think about that time value of money. So if you're lending $1,000 today, even though you're going to get 1,000 back 10 years from now, it's not going to be worth the same. It might only be worth $800 relative to today's money, right? And that's inflation. So interest rates are bonds in this case, and the two levers that we're going to talk about for the purpose of today's video, because I need to keep it shorter, is credit risk and duration risk. So that's what we're just going to focus on. So credit risk, we've kind of just talked about, are they going to pay you back in the end of 10 years, right? Are they going to run away with the money, right? So you need to, what you would do, like, we're not going to go into everything, but you would look at their character, their history, the good track record. What are they planning to do with the money? They should tell you the purpose when they do the issuance, like what are we going to use the money for? Sometimes they just do general purposes, but sometimes they tell you exactly what it's for. Do you have collateral? Where are you going to be in the credit stack? Are you the top primary lender secured by something, or are you just a general lender underneath everybody else, like a junior or mezzanine? So you need to be aware of that when you're picking individual bonds, which can be hard. And each bond is unique, so you need to be able to read them. So a lot of people, and they're also illiquid, so a lot of people don't buy individual bonds, and usually it's not recommended because you can really hurt yourself if you're not sure what you're doing, especially if you go into corporate credit. Government credit, obviously, if you can print money, is seen less. So on the federal level, usually government debt is seen as risk-free debt. So this is kind of where your credit risk is very low. So how I use bonds is usually with low credit risk because I take enough risk already with my equities. So that's kind of how I treat it. Because again, I want the bonds to be there so I can take advantage of the fear that we just saw in April, right? And who's to say it doesn't happen again? But that's how I treat it in my head. So I use bonds as defense, and I don't want to take credit risk. So that's just how I do it. But other people would want maybe a higher fixed amount of income every month, right, or year. But it's just, you need to be aware when you're buying bonds, especially individual bonds, what exactly you own. Because you own a part of something, you need to know exactly where you are in the credit structure and what assets are behind it, if any. Duration risk is the harder concept, so we're going to spend a little bit longer on that. And that's just, again, if you lend somebody at 3% in a year, but say if you, we're going to talk about this as well, if you can put money in a GIC at a bank at 5%, so say if you can lend at 3%, or you can just put your money in a bank account and earn 5%, you're going to put your money in a bank account and earn 5%. Basically, that 3% bond is no longer sexy. And so what we're trying to say here is, as interest rates go up, bonds, your current bonds, if you own them, are no longer as sexy. So they go down in value. So think of it like popularity, right? Like, why would I be willing to lend at 3% when I could just put my money in a deposit bank and earn 5%, right? No risk, right? And make more money. So that's why bonds go under pressure when interest rates go up. So a primary component of bonds is when interest rates go up, bond prices go down. And I just view it in my head as a shortcut. Just, they're no longer as sexy. And then there's also the duration component of this, which is duration risk. And this is where, say, if you sign on for 3% returns for 10 years, so 3% coupon for 10 years, but inflation's 5%, that's not good because the money you're getting is losing money in real terms. Like, you're actually getting poor even though you're making 3%, because inflation's 5%, everything you can buy is 5% more expensive. So you're actually poor in real terms. And that's what a lot of people don't understand too much with bonds. But it is the primary reason why bonds have underperformed since COVID, is because inflation's been so high, and inflation expectations have actually set higher for, I mean, the bonds have priced higher for longer for over 20 years now. So basically they're saying what we're currently seeing is going to happen forever, which is always interesting. And that's why I wanted to get this video out here, because at some point the bonds, just like the stock market did in a month, they're going to start coming back the other way. And I have a couple good charts here later on to show, but we're going to go into some examples really quick. I'm already over what I wanted to be in terms of time, but we're just going to look at short duration, long duration, average corporate credit, and high yield, just to show them really quick. So here's XSB. So this is just short term. And the only thing you need to be aware of for the purpose of this video is who you're lending to. So this is government. So basically, and a duration. So short term is 2.6 years. And we're going to explain what that means in a second, but I want you to see the context of why it matters. And you can see the 10-year return is only about 2% annualized. So not too great. But again, very low duration risk and very low credit risk, right? So did this beat out in real terms in terms of inflation in the last 10 years? Probably not, right? And you can see in terms of the credit risk, how people measure it is usually triple A's, A's, and single A's, and anything BBB or greater is investment grade. But governments and provincial debt in Canada is usually AAA or AA. And you can see the top 10 holdings are the Government of Canada, but you can also see some other ones here like Canadian Housing and Ontario Province, right? Royal Bank, Canada Debt. So there is some corporations in here, but it's largely federal and provincial debt. That's just worth bringing up. So when you look at a sheet of like a bond ETF, so this way you don't have to worry about individual bonds. It's a basket of bonds. So that's how I do bonds, is through baskets, because it's just way easier to get in and out of them. Basically, I want them liquid because I'm using them to buy stocks, right? This is my defense, and then when there's fear in April, this is where the money comes from to buy the things I want to buy that I've been waiting to buy, right? So that's the idea, and this is one that I've used in the past, just to basically park cash. I don't take too much credit risk, I don't take too much inflation risk, and then when something happens, I just pounce, right? Because it's liquid, I can sell it today and buy the equity the same day. Same thing with XLB, but this is long duration. So this, instead of 2 years, it's 14 years, which is a huge impact. But you can see on a 10-year basis, they've only made 1%, and they've actually lost money on a 5-year analyzed basis. And that's inflation. Inflation has crushed bond prices over the last 5 years. And now they've just started to come back in the 1 year, make up some for lost time. And I think this trend will actually continue down the road. So I just want to point that out. Again, this is just government. So low credit risk is high duration. So basically XSB is short duration, XLB is long duration. I can use them both as we're trying to go up and down the channel on the curve. So, and then here's just credit risk. So I just wanted to show a credit risk. So it's like an average duration of 6 years. You can see it's performed better than the other ones, but you're taking more credit risk, right? And decent on the last year again. And you can see a lot of them. This is Canadian. You're basically going to see a lot of banks and a lot of telcos. Well, and energy too. Probably average. And again, they kind of tell you where they are in the credit structure. So instead of being in the AAAs and AAs, you're now more in the BBBs and A's, right? But now you own the debt of banks, right? Which could be a complication if I was trying to diversify and already own bank equities, right? Which we have before. And then here is just high yield. So this is instead of just going for average risk, like so that those are Canadian banks that you owned, right? So they paid a little bit more, but you had more credit risk. Here you're going up into credit risk. So companies you've never heard of before. These are the top holdings, right? But luckily it's diversified, so there's a whole bunch of them, so you don't have to try to pick an individual bond that's going to work out. You just need to know that you're higher risk, and you can see it has outperformed the other ones, but you've taken more credit risk to get it, right? That's what I wanted to point out here. And you can see now you're not in investment grade, you're actually in double Bs and Bs, right? And even triple Cs, which are pretty dicey. So that's just worth bringing out here. And that's how the levers that I use in bonds, basically, those are my two drivers. And I'm like, am I willing to take credit risk now in bonds? No, because it's been no for a while. One, credit spreads are so bad, and two, I take enough risk in equities already. The purpose of bonds in my portfolio is to give me something to sell to buy equities when people panic. That's how I treat it, and that's how I articulate it today in today's presentation. But other people will treat it differently, especially as you're older. You're actually on a permanent percent of your wealth in bonds, right? Where I'm trying to be more tactical, partially because I have a longer term time horizon. And I also have ability and willingness to take on more risk than most people. This is just duration, and this I made ChatGPT make it, but basically what you need to see, so left to right, the zero column here, that's if interest rates do nothing, and then you have if interest rates go down 0.5 at a time, what the reaction could be on bond prices. And basically, as rates go up more than expected, bond prices go down. So they do very bad as rates go up. So if rates go up from left to right, you can see the bond prices go down, and they go down a lot more if you have a lot more duration. So basically, the more you go out, the more impact interest rates have. And that's the reason why the XLB underperformed the XSB, even though you're lending farther out in the future. It's because interest rate expectations shot up so high, because inflation expectations shot up so high. So I want to point that out. So that's why duration risk really does matter. That's why a lot of people got crushed in 21 and 22 in the bond market, going longer on the curve. No, now you could probably make the point that perhaps it's overdone. And we'll get into that. These are just my thoughts. So this is the 5-year rolling average of XLB and XSB. So again, one has the 13 to 15 year duration. Right now it's around 14. And one has the 2 to 3 year duration. And you can see, usually, because you're lending farther out, you would expect XLB to make more money. So in the rolling 5-year average, you made 7.5% versus XSB at 5, right? And you can see that's a decent spread of 2.5%, right? But you can see it starts going down and down. The difference between the two in terms of an annualized basis slowly start approaching each other, especially around COVID when inflation starts going into the numbers here. So when you start seeing 2020 go into the 5-year range, you can see this thing shoot down. Now we're only 0.7 spread, right? And now we're 0.5, at 0.3, even, and now we've underperformed XSB on a 5-year basis. And that's the power of inflation on bonds, especially bonds that have higher duration. So they've underperformed because inflation expectations are high and they're expected to stay high for at least the duration of this ETF, so 13 to 15 years. That's what this is showing me. Now, that doesn't mean it can't reverse it. It actually probably will reverse. You just don't know when. And again, we're not trying to time the bond market yield curve shift down. We're just using bonds as an asset class to take advantage of equity pullbacks. But I just thought this was worth bringing up because it clearly shows usually XLB should outperform XSB because you're extending how much you're willing to lend farther out. But in the recent bit, because inflation was so bad, it just hurt XLB so much because it's so sensitive to interest rate increases that an inflation expectation said it just crushed it, and XSB actually outperformed it, even though you're lending at a lot lower duration. So that's worth bringing up. And bonds, the reason why is because bonds hate inflation, and COVID was super inflationary. When you shut down everything and then still give people money, they got to buy things, but there's only so many things they can buy because parts of this industry is shut down, right? Parts of the economy. Specifically, we saw how all the shifting shifted to goods from services, right? So, and that led to a lot of inflation, right? So, okay, so if they perform poorly when interest rates go up, and be partially because of inflation, then when do they perform well? And usually it's during unexpected economic slowdowns, so recessions that aren't priced in. And usually, so these are that's why when we go back to here, you can see in the 2000 to 2003 period, XLB did quite good because rates were getting cut. And rates usually get cut during recessions or expected recessions. And usually they're slow and after the fact. So the recession's already been ongoing, then they cut rates. So the bond market will start pricing it ahead of time. Anyway, so that's when they perform well. So they perform well during times of panic. And if interest rates get cut, which is usually when equities are on sale. So you can see what one is setting up the other. And then, right, this is the main concept I want to get across for today's video, is just bonds perform well during periods of unexpected recession. However, the greatest thing about bonds is it gives you the ammo to buy equities when the recession gets priced into the market. So bonds put you in a position to take advantage of sales during market panic, right? So and the concept here is what we've shown in April, right? It's a very condensed one. It was only 1 month. But we saw the panic. We saw panic since February. It was 8 weeks of panic, right? And we were able to take advantage of that tariff little board that Trump had, and it was on the last 3 videos that we've posted. So I view bonds as ammo, and it sets up the lever to buy the dip, but it also allows me to be in the right state of mind to buy the dip. I'm not freaking out like everybody else. I've been waiting. I have a plan, and I'm going to buy the things that I want to buy. And that's where these comes from, right? That's from bonds, buying these things, waiting, panic, buy, right? And you never know when the bottom is. Like, even if you listen to the videos that I just did, I didn't know, right, that it was going to bottom. We just knew that the panic was high and the volatility was high. And for all I know, the next couple tweets to send it back down again. I gotta get myself back in a position to buy it again, right? So that's kind of what I'm doing now. Is I was trimming a lot of gains on Friday, and I'll probably trim some more on Monday, just to set myself up again to buy in case there's a panic, right? But that's kind of how I view bonds in a portfolio. Now, there's also something here. I was going to end on a picture, but I didn't generate it in time when I wanted to get this out. But basically, bonds also perform well during periods of deflation. Now, one of the reasons why bonds actually did okay before COVID is because interest rates were going down, because governments were having a hell of a time to get inflation over 2%, if you can believe that. They really struggled. And it was because of productivity from technology. So computers and stuff like that and internet were actually highly productive for people. And that's actually deflationary. So oddly enough, if you believe in AI, and obviously I do because of the equity exposure that I have to certain things like NVIDIA and AMD and Google and Microsoft and Amazon, is bonds will actually start performing again if half of what they say about AI is true, which will be interesting, right? especially because the yield curve is basically priced in higher inflation expectations forever, right? At least for the whole 15 years that I showed on that one chart. So I just wanted to end there. I hope that helps kind of how bonds are kind of a defensive part. They're never going to outperform, right? Or I should say never outperform. They won't shoot the lights out in performance. It's not like I'm going to get a 26% one day move in Tesla, right? They'll never be like that. They'll just pay a steady income stream semi-annually or quarterly or however the ETF's set up, and then you get just that steady income. So different mindset, but one feeds the other. So I was able to attack because I had defense for the fear that happened in April. And that's the main concept people often miss. They kind of have this static, I'm 60-40, and you don't need to be. You can tactically be like, okay, now I can take advantage of this fear, right? You can jump and say, okay, now I no longer need my 20% bonds. I can shoot it into equity for a bit, and then I can pull it back now that the fear's over, right? That's how you can tactically take advantage of fear, and bonds just give you that ability to do that, because otherwise the money had to come from somewhere to buy it, right? And you never want to just borrow, or 95% of the people I would never ever suggest borrowing to take advantage of fear, right? So it needs to come from somewhere, and usually bonds are just a great, especially liquid bond ETFs are just an easy place to sell, and I can buy equities the same day, right? So I just wanted to share that. It's kind of how I treat bonds in my portfolio. And usually if I'm more fearful, if things have been good for a long time, I'm going to start building these up again. These are kind of like gradual things. So markets keep going up, I'm slowly trimming. I'm just going to put some into these, right? And then I start to cycle again, right? So I think it was 2 years ago, started buying ATCO, right? And AT&T, right? These are more, they're still equities, but in my mind, they're more defensive equities. And then it allows me to also sell them and take advantage of the fear that we saw in April, right? So that's kind of how I shifted inside the equity asset class. But anyway, I like to know your thoughts on bonds. I tried to articulate as best I could. They are harder concepts, but again, you're basically a lender instead of an investor is how I treat bonds. And each bond's unique. So if you're actually picking individual bonds, I would recommend that you read the bonds that you're buying, the actual prospectus, because each one can have unique bells and whistles on them. And yeah, I like to know your thoughts, and have a great rest of your week.